Name is John, and I'm the CEO of Fola Capital Corporation. So we're a SEC registered broker dealer, and we're really jacked that you're here live today or you're watching the recording. So thank you for your interest in our webinar and our topic tonight. A little bit about myself, not to bore you to tears, but it does have something to do with the opinions that we've put together here on the material. I started a company. I did the startup thing in 2003. And I ran that company with a couple of partners for 17 years. And I sold it in 2020. I was lucky. We survived and we made it to an exit. That's relevant today because as we talk about all the challenges of entrepreneurs, particularly startup entrepreneurs, I could speak with firsthand knowledge of that, having lived through that myself. A lot of what I've learned from that, we've actually folded up into Fola Capital. Fola Capital has been registered with the SEC now for 3 years, and we're an investment banking firm, and we are a broker dealer that assists entrepreneurs, startup entrepreneurs, and active businesses in raising capital. And we do that under several exemptions that we're going to talk about today. So that's a little bit about me and Fola Capital, and we're going to get right into the topic of the day. We use a platform called Click Meeting. It's the European version of Zoom. We obviously like it better. It's a little different format. We have enabled a chat screen for you all. You can put a question in there at any time, and we will get to your question if time is allotted. If you put a question there and we don't get to it, we will get back to you with an answer. So feel free to use the chat field that you should see there in front of you during the session itself. So the topic today is revolutionizing your capital raising journey and unleashing the power of SEC-Exempt offerings. That's a bit of a mouthful, but I'm going to define all that today over the next several minutes. And in order to do that, we've got to have a bit of a history lesson. We have to look at the history of the Securities Act because that's very important context for what we're allowed to do today in terms of raising capital, and I will cover that. Within that context is this concept of exempt offerings. That's actually language that was used in the original Securities Act of 1933. And the word exempt and exempt offerings and exemptions are throughout the act itself, the writing of the act. And I'll define those for you and talk about the nature of exemptions. We'll also talk about how technology is disrupting the process of raising capital, just as it's disrupted almost every other aspect of our lives. And we'll talk about that as well. And then we'll compare the old way of doing things with the new way of doing things and kind of sum up today's discussion around that. What I really want you to leave with today is a sense that there's a new way of doing things. It's exciting, and it ought to give entrepreneurs a fresh sense of and fresh motivation to pursue their dreams and to fund their businesses, whether it's an active business that needs more capital or a startup. But in order to do that, we got to go through a little bit of cloudy skies and a little bit of doom and gloom. So let's do that right now. Before I get too much farther, we are an SEC registered broker dealer. We're regulated by the SEC. And the best piece of advice I can give to somebody who doesn't live in our world is go to these two resources that are published by the SEC. The report on the left is an annual report that the Office of the Advocate for Small Business Capital Formation puts out. What the SEC does within this office is they aggregate all the data on all the money that's being raised through these things called exemptions that we're going to talk about. And they crunch the data, and you can look at the data by state, and they got pretty reports and graphics in there that really summarize what's going on an annual basis. And I'm going to pull a couple of examples during our talk today from this particular report. The other thing the SEC has done, which I push a lot of people towards, is the Small Business Capital Raising Hub. It's a live website. You're only seeing the top of it, but if you were to go to the website and scroll down, there's a ton of great information for entrepreneurs and investors on this website that the SEC maintains. So I highly recommend that if you're interested in the topic of today, that you really do a deep dive into this stuff and go right to the source, the SEC, and these two great resources to check out what some of the things we're going to talk about today and more. You know, having been an entrepreneur myself, I can kind of just paint a broad picture here and say the following, that it's raising capital simply looks a lot easier than it really is in real life. And many of you who are entrepreneurs are probably living that now. Um, this is a good example. So this is a document I picked up at an event I went to. I live in North Carolina, so I go to this entrepreneur event. I like to call them revivals because most of the time it's lots of positive vibes and positive messages, and we leave there all happy that we're entrepreneurs and all excited and what some of the things we learned. But what happens by accident is we leave these events sometimes thinking it's a lot easier than it looks. For example, I picked up this little booklet published by the SBA. Now, the SBA is awesome, nothing against the SBA, but if you go to page 19, there's a 10-step process to start a business, as you see here on the right. Step 1, conduct market research. Good idea. Step 2, write your business plan. Great idea. And then you get to step 3 and fund your business. And if you zero in on this, it simply says your business plan is going to tell you how much money you need. And then period, investors and lenders will help you get that money. Simple as that. Now go on to step 4, pick your business location. And folks, it's a little tongue in cheek here, but it's not that easy. It's a very complicated process. And as you'll see over the next few minutes, statistically, it's very hard. So this is an image that comes from that SEC report I mentioned a couple of minutes ago. And you can read this slide yourself. And it really just summarizes in very black and white forms what percentage of entrepreneurs are struggling with capital out there. In fact, it's listed as the #1 barrier to company survival, not just success, but survival, not just getting into business, but once you're in there, staying in business. 75% of us report that there's challenges in obtaining capital. Almost 90% of us can't grow because there's a lack of capital. And actually, close to 80% of us are really worried about survival and where capital is going to come from. So I'm not being an alarmist, but if you look at surveys and studies, the lack of capital is a huge, huge issue. And I'm sure that if you're on this webinar right now, given the topic, you probably know that firsthand. So I'm not telling you anything you don't already know. So where do we get the capital becomes the question. So let's look at banks first. So this data is from Biz2Credit. If you go to biz2credit.com, on a monthly basis, this organization updates approval rates on banks of all different kinds and sizes and a bunch of other statistics you might be interested in. Well, this particular graphic is probably no surprise to anybody, given the current banking environment in the country today. Getting a bank loan is extremely difficult for existing businesses. And in my opinion, in my personal opinion, based on my experience and what I do every day, it's almost impossible if you're a startup to get a bank loan, particularly from a nationally branded large bank, without mentioning any names. So if you look at bank approval rates, you can see for yourself, big banks approve about 13%, a little over 13% of the loan applications that are brought before loan committees, 13%. And what's a little misleading around this, these are the applications that were actually submitted that were approved. 13% of those were approved. But we don't talk to the underwriters or the bank loan approval committee. Who do we talk to? We talk to the loan officers at the front of the bank when we walk in, or call somebody on the phone or through the internet these days. We talk to loan officers, and loan officers report that they talk to 10 to 12 people who are looking for a loan for every one that they encourage to apply and fill out that application. So as we go and knock on doors at banks looking for bank loans, we're one of those talking to loan officers. And, we might be lucky enough to be asked to apply, but then even if we apply, you can see the approval rate. So it's extremely challenging to get a bank loan these days. So if we can't get a bank loan these days, next thought that comes to mind is investors. So this is another great report I encourage people to find and download. This report can be found at the Angel Capital Association's website. It's a very informative educational website. One of the great things you can get there is this report. So the last time it was issued was in 2022. And like the SEC report, this particular report kind of aggregates all the investments that are going on in the angel capital world. And this particular figure 19, is the one I pulled out that's relevant to today. And if you look at this figure, what this is telling us is that for those investments across the country that do happen, almost 75% of those investments are made in either IT related companies or healthcare related companies. And healthcare kind of breaks down into drugs or medical devices kind of companies, right? And on the IT side, it's mostly software. So almost 75% of the investments that are made by equity investors across the country, and this is true for the venture capital and private equity levels as well. We're down at the angel level where most startups start. If you're not in one of those two categories, your chances of getting funding statistically from your local investment group are pretty nil. So it's just statistically. And in fact, what these angel investors are looking for, the mold that they're looking to fill, and I don't know why they don't tell us this as entrepreneurs. We learned this the hard way. Really, what they're looking at, the lens they're looking at us through is, can I get a 10x return within 6 or 7 years? That's the model they're trying to fill with their investments. They want to place a lot of bets on the table that fit that mold. And the question we then have as entrepreneurs is, do we have a business and a business plan that goes along with it that actually tells a strong enough story to get these investors to believe that we're going to provide that kind of performance and return within 6 to 7 years? And for a lot of us entrepreneurs, we simply don't have the business model to achieve that kind of scale and time. And that's why a lot of us don't get investments. In fact, when I talk to angels and VCs, which I do quite often, I like to ask them 3 questions. The first question is, how many companies come to you every year for money? And the answer they give me is always in the hundreds. It's usually 200 to 400, depending on how active the angel group is, or if I'm talking to a VC firm, they easily get 200 to 400 a year. The second question I ask them is an important one because it relates to what we're going to go to in a couple of minutes. The second question I ask them is, okay, out of the 200 to 400 you talk to every year, how many do you actually fund? And guess what the answer is, right? It's always less than 10. The number is always less than 10, even for large VC and private equity firms. All you got to do is go to one of their websites and look at their portfolio and then see when those investments were made. And almost every time I do that, they always invest in less than 10 a year. And here's the reason, folks, because the old way of raising money that we're talking about, there's a lot of time and effort invested by those angel groups and VC and private equity firms in something called due diligence before they actually write the check. And we're going to get back to that in a minute. So they put a lot of effort into due diligence. During that time, they decide not to invest in a lot of companies they look at. But for those lucky few that they invest in, about less than 2% of all the companies, they get less than 2% of the companies that come to them for money every year are those that get investments. And the third question I like to ask them is, I like to ask them this question, but they hate the third question. And here's the third question. Here's the question. Of the ones that you invest in, how many do you make money on? And here you see the statistics, right? Here are the stats in the answer to that question. 65% of the time, they either lose all their money or get 1x their money back. And this is after years after investing in a company and watching it do what it does over a period of years, right? Oftentimes they lose their money. Really, where they make their money is on the very few that get 5 to 10x returns, right? By making all that money off a couple of their investments, they're making up for all their losses on their other investments. And that's the angel VC model. There's nothing wrong with it. The important part about going over this today, given our topic today, is we have to understand that that's their model if we're an entrepreneur trying to find money. And unless we fit that mold, we don't really have a chance to get traditional equity investors' money or an angel investment group's money. That's what they're looking at. I don't know why they don't tell us this when we're being new entrepreneurs, but we're telling that to you today. My last question, which I like to ask, is, well, if you're that selective on the front end, how could your batting average be like this? Well, how smart are you in picking the winners? But anyway, that's a discussion for a different point. So that's a little bit of doom and gloom. I'm just using stats from these reports. Don't shoot the messenger. The bottom line is it's extremely difficult to raise capital the traditional way. And oftentimes the stats prove that out to be. We're either the wrong kind of company. If we're trying to open a bakery or a services company without a product, or trying to, invent a new product that we think's got great potential, but it's not in IT or it's not in healthcare. We get frustrated as entrepreneurs trying to find capital. And oftentimes, quite frankly, we're just knocking on the wrong door statistically. So let's shift gears now and talk about more exciting things, right? Something we call private placements 3.0, raising capital through exempt offerings the modern way. So let's kind of define the modern way by going back in history. So let's talk about the history of this thing called exemptions. And without understanding the history, we really don't have an appreciation for today and what we can do today. So, this is a quiz that I do in a workshop that I do. And I ask people, okay, of these 5 things that we're all familiar with, some more than others, what's the one thing that in 1933, through the passage of the Securities Act, the federal government said, can't do this anymore? I won't hang you out on a limb here, but it was invest in a private business. And this came out of the stock market crash of 1929. It took Congress almost 4 years to act in reaction to the stock market crash. Before the Securities Act was passed in 1933, the public exchanges and securities were really regulated at the state level. There was no SEC, there was no federal oversight or regulation of the securities markets. And quite frankly, a lot of bad stuff happened. And you can read books about it, which we have here at Fuller Capital, and it's a pretty fascinating story. It wasn't all greed and fraud. It had something to do with margins and stuff, margin calls and stuff like that. But anyway, the federal government said, which was 3 generations ago, folks, 90 years ago this year, said to most Americans, you cannot invest in a private business unless you're rich. Something that SEC came up with a word for it. The word is accredited investor, and I'll define that for you in a minute. But basically, it's a wealthy individual or household. But they never said we couldn't do the other things. So some of us go to casinos and spend way too much money, and we most of us lose money at a casino, right? Some of us invest in real estate. There's no wealth gate or net income gate or any gate that the government puts on any of us to buy a rental property. Isn't that kind of funny? You can buy a $300,000 house if you can get a bank loan for it, but you can't invest in a private business. And the real irony is, the government, state governments actually run the lotteries in most states. The government runs the lotteries, and there's no limit on how much you can spend on lottery tickets, right? And then we can take out our life savings, which many of us do as entrepreneurs, and bet it all on our idea and lose it all, and the government's not going to stand in our way. But if we want to cut a check for a private business, that's largely been illegal since 1933. There's some good news coming though, folks, if you can't tell. So this is the current definition of accredited investor. I'm amazed at how many people have never heard those words. And when they hear them, they have no idea what we're talking about. But the SEC, Congress actually changes the standard for accredited investor and has several times since 1933. This is the current definition. There's more to it than this, but basically you have to have $1 million in net worth, not including the equity you have in your primary home, or you make $200,000 a year or $300,000 a year if you file your taxes jointly with a partner. There's more to it than that, but basically that puts you in this category of accredited investor. And why is that important? Well, let's look back in history here. And really, these things have gone through what we kind of clumped together as 3 phases. So the first phase started with the passage of the Securities Act of 1933. Quickly behind that came the Securities Exchange Act of 1934. And we call this period of time private placements 1.0. And really what these things did were 2 big things. One, it created the SEC, the Securities Exchange Commission, the national regulating of the securities markets, which we still operate under today, the Securities Act of 1933. What these laws did was it created the FDIC, which guarantees our deposits in FDIC insured banks. And the message to send to the American people was a couple of things. Number one, put your money back in the banks because we're covering it. We're going to insure those deposits. feel good about putting your money back in banks. So most of us feel pretty safe when we put our money in our bank accounts, right? There's been some scares recently, but most of us culturally feel pretty safe about that. The second thing they said was you have to be an accredited investor in order to invest in a private company. And you saw the modern definition of that. But that was very few people back in 1933. And they said, look, unless you're accredited, don't even think about investing in a private business anymore. But they were smart enough to write in the law. Congress was smart enough to say, look, there's going to be exceptions. You know, what they said was if a company wants to raise money, they got to follow all these new rules and go public on the public stock exchange, right? That still exists today. But Congress said, you know what, there's probably going to be some exceptions. Back in 1933, it wasn't that well defined, but they used the word exemption in the law. And they created these conditions where a company would be exempt from having to go public. They can still raise private money under a certain different set of rules for that particular exemption. And the first exemption was known as Reg A. So when the SEC first passed the law, and when it created the law, Congress passed the law, they had this Reg A exemption in there where a private company in 1936 could raise $100,000 without having to go public. And the rules under that said only accredited investors, which meant very few companies were doing that back then, and very, very few people, particularly if they lost a lot of money in 1929, could and were investing in private companies using those exemptions. So that was private placement 1.0. Then an amazing thing happened in the 80s. A significant thing happened in the 80s. A couple things in particular. Number one, computerized the securities industry. So it used to be we used to shout at each other on a public stockroom floor. They were all replaced with computers. Okay, everything's done with computers. Started in the 80s, just like every other industry that we're part of, right? But the second significant thing that happened in the 80s was Congress authorized a new exemption called Reg D. There's actually three kinds of Reg Ds. I won't bore you with the details. But in addition to Reg A, which they enhanced in 1992, they enhanced Reg A, so now you can raise up to $5 million in 1992 using the Reg A exemption. And the Reg D exemptions, there's three of them, you can raise an unlimited amount of money. It's just a different set of rules. And this Reg D exemption came out in the 80s. And computer automation was all the rage. But look at what the introduction of the Reg D exemption did for the private capital markets, which we're talking about today. What you're looking at is the public and capital that was raised in the public markets and only under Reg D, never mind Reg A. Just Reg D is the green part of these bars, okay? The other two colors, the brown and the blue, the little baby blue down there is the amount of money that was raised in the public stock exchange through IPOs, initial public offerings, or follow-on offerings, new offerings by companies that were already public. In other words, they issue more stocks, they need more money. So in addition to what's already floating on the public exchanges through an IPO, they'll issue new stock. It's pretty routine that happens. But we think that that's the bulk of where investments are made today in America. It's the baby blue part of this bar. The brown is actually public debt, bonds, things like that you can acquire on the public market. So if you take the blue bar and the brown part of this bar and add it together, that's the public markets. But look how it compares to the green. The green is the private investments in private companies under Reg D. And the substantial event that happened was in 2017, for the first time in history, and it hasn't stopped since, more money has been raised in this company for private companies under Reg D than in the public markets. And that happened in 2017 and hasn't stopped since. And Reg Ds didn't exist before the 80s. Keep that in mind. You can also see through these graphs, particularly the one on the left, how much money's been put into private funds every year by college endowments. Even municipal governments are putting some public money for public employees in private funds through private equity and venture capital to invest in private companies through Reg D, Reg A, and Reg A offerings, particularly Reg D offerings. So lots of money has been put into this, and there's been some unintended consequences associated with this. And here's a big one. You know, if you apply the definition of accredited investor to the U.S. households. I gave you the definition for individuals, but if a business by definition is also an accredited investor under the definitions. But what this particular pie chart looks at is individuals. So there's about a little under 11% of American households across the country fit the definition of accredited investors. But look at this, folks. Almost 76% of the wealth of this nation is held by 11% of the population. Let me say that again. 76% of the wealth is held by 11% of Americans. And, you know, we've probably heard versions of that before, but people that look at this all the time, like we do, attribute this mismatch to 90 years of what wealthy companies continuing to invest in private companies, not public exchanges. Remember, private company returns don't correlate to the public markets, generally speaking. They're under the category of alternative investments, and those words are used to say it's an alternative to the public markets that we're all familiar with. Well, the good news is that this recently changed, and now, and I'll get into this next, we can rewind the clock to 1933. Guess what? Good news. We can all invest in private companies again. So that takes us to Private Placements 3.0. What happened was the Jobs Act of 2012, very similar, but not as drastic as the reaction of the Securities Act of 1933 was a reaction of the stock market crash of 1929. When the economy took a huge dip in 2008 in this country, Congress acted to try to help small businesses recover from that. And they made another series of enhancements to the original Securities Act of 1933. And that part of that was embedded within the Jobs Act of 2012. And the significant thing that the Jobs Act did was two things. The government now said, for the first time since 1933, there were some exceptions where non-accredited investors can participate in Reg Ds in particular and Reg As. I won't bore you with some stats there, but it's low. But now they say normal people can now participate in private placements again. But the second thing that the Jobs Act did was it required that the internet be used for a particularly new kind of offering called a Reg CF offering. Now, CF stands for crowdfunding. I personally wish they never used that word because when you say the word crowdfunding, people think of Kickstarter and all that. That's not what we're talking about here today, folks. We're talking about a new exemption. It has its own set of rules, just like Reg D does, just like Reg A does. And but it's a new exemption. And two things about that new exemption. Number one, anybody can invest in a Reg CF offering. You don't have to be accredited. And number two, you have to use the internet because that's how the SEC regulates what goes on with Reg CF offerings. And I'll leave it at that. It's the only exemption where you have to use the internet. But drum roll, please. The reason why there's disruption going on right now that we're talking about today and how you raise capital is if you use the internet for those other exemptions, particularly Reg Ds and Reg As, wonderful things can happen. You don't have to use the internet, but the efficiency it brings to those exemptions and the reach you can get to new investors is incredible and very disruptive. In fact, this graphic helps to illustrate kind of the disruptive nature of the new kind of capital that's available to entrepreneurs today that was not available prior to the Jobs Act. This particular graphic is put out by an analyst in our space called Investibule, and it does a really good job visualizing what we're talking about here. So this is kind of like the pyramid of capital, and on the right side of this triangle, that's kind of like the traditional food chain, right? You start with angel investors at the bottom with pretty low investments, and then the more money you need, the higher up you go on the food chain of traditional capital. And what Reg CF basically did was it opened up a huge swath of new capital in America. There are trillions of dollars sitting in bank accounts, sitting in IRAs, which can be used to make private investments, by the way, retirement account funds, all which can be accessed legally for private placements if the rules are followed. It's trillions of dollars. And we in the industry like to say it's kind of like fracking for capital, right? You're trying to cast a really wide net and again, get a bunch of smaller checks to come back, and those checks form your investment. Now we're able to do that as entrepreneurs, and we weren't able to do that before the Reg CF exemption was approved as part of the Jobs Act of 2012. So back to our timeline here, private placements 2.0 is really when we computerized the process. We computerized the old process, and we introduced this thing called Reg Ds. And private placements 3.0, our definition for that is this new world we're in. And what makes it unique is the application of the internet. The internet is disrupting the function of raising capital, just like it's disrupted every other aspect of our lives. So that is the true innovation here. It's not so much Reg CF, it's actually the use of the internet, which you have to use for Reg CF, but if you use it for the Reg Ds and Reg As, wonderful things can happen within the rules that the SEC has given us to govern the industry. Further enhancements were made in 2022, the Jobs Act. When it first came out, we can raise up to $1 million under Reg CF. In 2022, they made enhancements to all the exemptions, by the way, but the one big enhancement was made to Reg CF, that they've moved that from 1 million to 5 million. So today we can raise up to $5 million under Reg CF. I just want to pause here and remind anybody, if you have a question anytime, some of you came in late, please feel free to put a question in the chat box there that you should see in your field of view. So let's break down these exemptions in a little bit more detail. There's basically 6 of them. So there's 6 exemptions. And what makes one exemption different than the other are the rules that you have to live by under the SEC regulations. So different exemptions have different sets of rules. And really the 4 key topics, or the 4 big differentiators, and what makes one exemption different than the other, are the ones you see on the left here. It amounts to how much can be raised. And as you can see, a lot of money can be raised by most of these exemptions. Secondly, who can invest? Can accredited investors only invest? Can only non-accredited investors invest, or a combination? You can see that for yourself. The third one's a big one, which is advertising. Can you actually advertise the offering or not? And this is particularly important in this age of social media. So 506, Reg D 506B, for example, you cannot advertise at all, not even on social media. The only thing you can do is invite people that you have an established relationship with in order to take a look at your investment opportunity and invest if they want, right? I'll get back to 506Bs in a minute, but that's different than a 506C, for example, which you could publish a Super Bowl ad or put a big billboard advertisement up on the highway near where you live, advertising an investment opportunity under 506C. But on the other hand, only accredited investors are able to invest. So you can kind of see the difference here. The last one is whether or not you need an audit. If you have to have your financial statements audited or not, you need to, you can see the rules there for yourself. So these are, just remember, you don't need to memorize a slide. Only what I'd like you to know is that there's 6 of them. These are the most common ones. And really, I'll whittle this down even finer for you. Really, the top 3 are the 3 you see on the right. Most of what most people on this call are going to get involved in are one of the 3 on the right. And I won't get into all the reasons why. But you can see where most of the activity happens on the 3 on the right. And if we go back to our SEC report, you can see the magnitude of this. And this is another image from this report. And if you look at this particular part of the image, this is one of those exemptions, Reg D 506B. This is the one where you can only invite people in. Look how much money it raised in 1 year. $2.3 trillion, folks, in 1 year. And crowdfunding that same year raised $368 million. Now, in the context of $2.3 trillion, that's a small number, but that's still a lot of money across the country being raised by entrepreneurs under the new exemption, Reg CF. And that's great because that exemption didn't exist a few years ago. So there's a lot of money, at least $368 million was raised within that year's time span that you're looking at, that you couldn't raise before Reg CF, and that continues to grow. And if you compare that number to IPOs, during the same period, there was only $126 billion raised through IPOs. That's about 6% of the amount of money that was raised just under Reg D 506B. And you think about the scale of that, it's pretty incredible. And if you look at all the other registered offerings, which is everything else that happened on the public exchanges, and you add 1.1 trillion of that, 1.1 trillion is still a little less than half of the money that was raised under just one of the private placement exemptions, Rule 506B. So it gives you a little bit of jaw-dropping stats there that without that context, you really wouldn't know what you're looking at. The other amazing thing is under Reg CF specifically, look at this pie chart. This pie chart is very different than the first pie chart I showed you from the Angel Capital Association, isn't it? All kinds of businesses get funded by Reg CF offerings. You don't have to be IT or healthcare related. You could be a bar, you could be a bakery, you could be all kinds of things. People invest in Reg CF offerings for lots of different reasons, and those reasons are often very different than what traditional equity investors are interested in. Because why? They're looking for 10x returns within 6 to 7 years, and those are usually in those two categories, where somebody investing in the corner beer garden or brewery or something that wants that in their neighborhood and they're happy with a less of a return than 10x. That's why these things are getting funded under Reg CF. So let's talk about the process next. This is an image of the first ATMs that were put out. And back then when the ATMs first came out, there was a person like this woman here who used to stand there and show people how to use the ATM. And we like to use that example as, I'm old enough to know when they came out. And I remember being afraid of them because I thought it was going to eat my money or my card or whatever, right? I didn't use them at first. And a lot of people were kind of afraid of them, didn't know how they were being used. Well, the analogy is that most of us are not familiar with investing in a private business. So that's actually the biggest challenge right now in the industry, is getting most people back into thinking about using their money. Of all the things they can do with their money, one of them is they can invest in a business that they care about under these new exemptions. But let's talk about the process for doing this, because for entrepreneurs, oftentimes it's very foreign to them as well. And I'm going to try to break this down for you. Now, I told you a little bit about myself in the very beginning. I only brought that up because this is the part where it's relevant. So I've raised capital the old-fashioned way. I've done a bunch of commercial loans for my first business. And I was part of the team that raised $2 million in a Series A with Angel Investment Group in Cleveland, Ohio. And I've gone through this. And then we did subsequent raises over the 17 years then. So I'm very familiar with this process. And let me tell you, folks, I'm not as old as I look. And the reason there's a lot of miles on this body is partly because I had to go through this process over and over again. So typically, this is the process. And I like to say the golden rule applies. Those with the gold rule in this context, right? So basically, when we go and we're actually lucky enough to get a nibble on our of interest, if a traditional investor is interested enough and maybe investing in us, they deliver something called a term sheet. So you're looking at an example of what's called a term sheet. And it's just a summary of their terms, right? And then that term sheet usually starts the process, and they hand us this term sheet. And there is some wiggle room there, but most of the time, not a lot of wiggle room. And then we begin this thing called due diligence. Now, let's look at the traditional process. So we go do our pitch to the Angel Group, or we go to a pitch contest, and then we think we're all fired up because somebody tapped us on the shoulder and says, kid, I'm interested in your business. So now we're all happy, right? So we go, and there's some initial interest expressed there, right? And then again, like I just said, usually if you get that far, you get to something in writing called a term sheet, which broadly describes the kind of conditions in which we would get a check from this group. But here's the part nobody tells us about. We then go into a long period of what's called due diligence. And this is where the investors do their homework. They want to look at a lot of things. And sometimes as entrepreneurs, we're not prepared for that. We have no idea what they're talking about. Things like a full set of financial statements, a background check on the founder and the management team. They want to see cash flow projections where we might have just done a pro forma. We have no idea how to do a cash flow projection, for example, right? They want to look at our operating agreement. We may not even have an operating agreement yet. So all these things are checklist items for professional investors, and entrepreneurs sometimes get frustrated because they're hearing things they've never heard before, and that's where things get bogged down. If we can get through due diligence, then we get lawyers involved, and then they write up what's called a PPM, or a private placement memorandum. In fact, I still have mine from my company on my desk here. And it's very thick, and a lawyer did it. I've never really read it, but it cost us about, I don't know, $25,000 or $30,000 for them to write that up. And then that is the document that contains all the regulatory disclosures and risks for investors. And that's the document that gets signed by investors who actually decide to make an investment. But the key step in this process is the due diligence step. And folks, this can take months or years in some cases as investors continue to exercise the idea of investing, and they're putting it into a framework and doing a lot of checks and balances before they write their check. And this sometimes takes a very long time and frustrates investors. I would tell you that a bank loan is somewhat similar. If a bank says you're pre-approved, that doesn't really mean anything. And then you actually apply, then they ask for 42 different things. That's the bank doing their version of due diligence, and it takes a long time. But the new way of doing it, it gets better, folks. Hang on there. We're almost done. So if we go back to this process, here's the good news, right? There's actually a new way of raising capital, and we're literally turning the process around. In the new way of doing things, the entrepreneur is actually creating a security that can be offered to the public under one of those exemptions. And then they're going to the community with that security through the internet most of the time. In the case of Reg CF, you have to use the internet. And we're casting a very wide net, potentially nationally, to try to get a lot of people interested in our company and invest through our exempt offering. And that is the new way of doing things, folks. So if we look at that process, the biggest difference, folks, is this. We start with due diligence. We start with it. The regulations, the SEC regulations require it. As an SEC registered broker-dealer, for example, we are bound by the regulations to conduct rigorous due diligence as a broker-dealer before we tell the public that this is a legal security through which you can invest. So there's a lot of due diligence. The same due diligence that occurs the old-fashioned way, it occurs up front. And then that leads to a PPM, which is then offered in the form of what we call an offering, which is just a place on a website or on a platform that's authorized to do these offerings. And then that is made available to the public, and then the public can decide whether or not to invest. So really where the time is invested in a new way of doing things is up front. And the good news for entrepreneurs is you own this process up front to the extent that you can commit yourself to putting a very good business plan together and conducting your own due diligence. These are the types of questions that people are looking at during due diligence. It's a busy slide. I'm not going to read it to you, but you can kind of take a sampling here of the kind of checks we need to make to say that we've completed due diligence. And when we complete an offering, this is kind of what an offering looks like, kind of in the weeds now. So the offering is typically the main document is something called a PPM, or the private placement memorandum. And depending on which exemption you're using, there's like 3 different kinds of master control documents, right? PPM is usually tied to Reg D. If you're doing a Reg CF, it's called a Form C. And if you're doing a Reg A, it's called an offering statement. I'll leave it at that. But it usually includes 3 supporting documents for a total of 4 documents. The first one is the operating agreement or the governance documents for the legal entity that you've chosen. Most LLCs use an operating agreement, but if you're a C Corp, it's a charter and bylaws and a subset of those things. A good, solid set of financial projections is also required. Again, we find entrepreneurs struggle with that particular piece. They just don't know how to do them. And but it has to be done, right? And really good ones model the investment terms that are being offered by the entrepreneur right there embedded in the financial projections. And then the security agreement itself is a separate document that gets signed by the investors when they make their investment. And that's the contract between the company and the investor, with all the disclosures and obligations on both sides embedded in that particular agreement. The good news for entrepreneurs is you don't have to do anything different than you learn in an accelerator program or in a class on being an entrepreneur, right? You have to do a good business plan. And a good business plan kind of breaks down into 3 pieces. You got to have your pitch deck, your investor presentation. You got to have your financial projections. That's usually the hardest one for most entrepreneurs, but there's help. There's hope. You can get help there at SBDCs, SBTDCs, and lots of other resources to get that done. And you can take a class and do it yourself or use some freely available tools. Anyway, that's the hard part. And then the last part that I tell people to do is the narrative. Because I like to say the only people that read narratives are academics who assign business plans to students and your mom. But anyway, the narrative is used, all seriousness, as a summary in the PPM, but it is important. But the other two are, you can judge for yourself how important they are in comparison to that. The reason that's important is the information in these documents kind of feeds this offering package. So we need from the entrepreneur what's in blue, and then people in this business create the offering documents that you see there, basically from the business plan. And then there's a whole bunch of regulations around these other filings that have to happen with the SEC. Don't worry about the details of these. Only know that there are some other requirements that whoever's helping you with this usually takes care of that you don't need to concern yourself with. So again, it's when we get to the point of putting an offering together, it's a two-step process. You select the exemption. Again, there's different rules for each exemption. And then you select the security type. And you can offer both debt and equity in the using this more modern way. And just a quick note on that, right? There's different kinds of offerings. So on the equity side, you can sell ownership or shares in your company, or use something called a SAFE, which stands for Simple Agreement for Future Equity. But even more exciting and more common these days are debt offerings. So there's some creative, innovative debt offering or structures being offered by people raising capital this way. Small business bonds are becoming more and more popular. In fact, the Wall Street Journal recently did an article on how many more small business bonds are being issued by entrepreneurs. But my favorite is the revenue share agreement. And I won't get into the details of that, but that's debt, but it's paid in a variable basis based on a percentage of revenue until investors get a specified multiple of their investment back. Multiples usually 1.5 to 2. But anyway, that's how RSAs work, and some really creative things are going on there. And then if you're interested in a hybrid, convertible notes and convertible bonds actually are a hybrid between these two things, and I won't bore you with details in the interest of time, but just know that there are choices when it comes to which type of offering to use, and then you tie that choice of offering up with the right exemption, put those two things together, and you have an offering. Last thing I'll say is for investors, it's important to think about investor liquidity. So this kind of graphic shows you liquidity. So liquidity means how fast can I turn my investment into getting cash back, right? So if you're on the public exchange, for example, your investment is absolutely liquid, right? Like you could buy stock today, sell it tomorrow, no friction whatsoever, right? So in the public market, absolutely one of the advantages is liquidity. When you invest in a private company, it's very, very, very illiquid. So if you need your money back quickly, or you might, an equity investment in a private company is usually not a good choice. Why? Because you usually have to wait for that company to get sold before you get paid back and get a return. And that could be never, or they can go out of business, but you have to wait till it gets sold. But there is this middle ground here called passive income, which is where revenue share agreements and bonds fit. This is kind of that's why you see a lot of these with private companies and private placements now. I can invest in your company today and I start getting an immediate return in the form of passive income. I like that as an investor. And by the way, I don't have to wait for you to sell the company to get my money back. So that's why you're seeing a lot of those being popular, not only with entrepreneurs, but with investors. So kind of winding down here, this is what an offering looks like. This is what an offering on our platform looks like, but all the platforms and broker dealers, if you're either a broker dealer and can do a lot of heavy lifting with your clients, or you're a FINRA approved platform. And most of the FINRA approved platforms can only do Reg CF, where a broker dealer can do any of the 6 exemptions. But anyway, very similar looking sites. You usually find a collection of offerings in the form of these tiles like you see in the upper left. And then you click on one of those tiles and it opens up all the information an investor needs to make a decision, which includes all the documents I went over in digital form. And then if you click down into the documents tab there in the middle, if you can see that, you'd get to the lower right and you can see all those documents I described that are there that can be easily accessed instantly. And if an investor wants to invest, they actually click on the upper right green bar there. It says sign in or invest. You create an account, which is free. And then you literally invest electronically through a DocuSign process. It takes about a minute or two to invest. And folks, that's the application of internet technology to the process of private placements in a regulated way. And that what you're looking at right here is the huge innovation in capital raising. So just to conclude, the news flash is not that sexy, actually. It's taking the internet and applying internet innovation to good old-fashioned exemptions. So when you're able to layer the internet and all the advantages of the internet and follow the rules, the SEC rules around conducting an offering under one of those three types of exemptions, it offers you immense efficiencies, less cost, more reach, and that's really breaking down barriers for entrepreneurs to get access to the opportunity to raise capital. Secondly, the entrepreneur is in control. This is a big deal. The old-fashioned way, you're not in control. Trust me. You're in control of the timing of their availability for due diligence, which again could be months or years. They're in control of the terms, which could change during due diligence. When you look at it the other way around, the entrepreneur is in control of all of that. They're in control of how long it takes them to get through due diligence. They're in control of the terms of the offering. Now, those terms have to be attractive enough for people who want to invest, but oftentimes it doesn't have all the traps and control mechanisms that traditional investors put into these documents. And that's the second big advantage. But I will tell you this, that despite what I call good news for entrepreneurs, if you're an entrepreneur today, you have these choices that weren't available even 10 or 20 years ago. And it's exciting. Even for people that are historically challenged, veterans, which I'm one of, minorities, women-owned businesses, that statistically, just read the Angel Capital Association's report. It's got these stats in them. They have less of a chance of getting traditional investment. This way, there really isn't that barrier. In fact, if you're in one of those groups, it's actually an advantage because other people in those groups that can now invest in your company might have an extra incentive to do so if you're a part of their affinity group. I'm seeing that happen over and over again. However, having said all of that, raising capital is still tough, folks. There's no guarantee you're going to be successful using the new way versus the old way. But the second thing I'll say is the old way is never going away. It's never going away. There's nothing wrong with the people that participate in the old way, by the way. They're great Americans. Without the trillions of dollars of their investments, we wouldn't be as strong as we are economically. However, what it has opened up, if you think about that triangle graphic I showed you, it has opened up trillions of dollars from new investors. These are younger folks. These are people that are passionate about certain causes and companies that support those causes. It's trillions of dollars of equity from new investors that can now invest in our businesses and entrepreneurs. So we have a choice. We can go to the old process and the old infrastructure that's always been there for 90 years and try our bet there. If we're healthcare or IT, we might want to do that. But what if we're not, right? Then we have this other ecosystem to go to try to raise our capital. So folks, that concludes today's presentation and webinar. I know I threw a lot at you. I hope I didn't confuse you or give you a migraine. I haven't seen a question come in, which tells me I did a great job or people are glazed over, which is fine. Really, thank you for the interest in the topic. Here's our contact information at Fola Capital. If you're an entrepreneur, we do a 90-minute workshop around this stuff. Be glad to talk to you. Have someone in our group talk to you and try to hear you out what you're trying to achieve. And if you're an investor, you might want to kick the tires on this way in investing. And I know some of you that signed up are in jobs that help entrepreneurs. And I want to thank you for being true professionals by investing your time into learning some new tools and tricks that might have some value for the clients in which you serve. So thank you very much for your time today. Have a great day and go out there and do great things for the small business world. Thank you.